What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is November 3rd of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I want to spend some time to get a big picture and look forward to the year of 2024 when it comes to Bitcoin, altcoins, and the broader macro perspective. What's going to be happening in stocks, bonds, and the global economy. And while I won't be able to dive into everything today, I think I'm going to help focus in on what we need to be looking at over the next few months and going into the next year that can help us to determine where things might be heading. We've got a lot to unpack here in today's video, so if you guys happen to enjoy it, consider dropping a like. It's one of the greatest ways you can support the channel here, and let's go ahead and kick off the conversation. So I want to start here by talking about the near term for Bitcoin and crypto. I think right now, over the past few days, we've had a little bit of a fade here from the relative highs near $36,000, coming down roughly around 3% here over the last 2 days, right back to where we were really ever since we had this major move in mid to late October up towards the 34K range. Altcoins as well, many of which were up probably around 30, 40%, maybe even 50% of the upside, have started to cool down some of those gains, and now those market leaders that have led in the altcoin rally, albeit it's not all altcoins, have definitely gone up still about 20, 30%. So there is still a kind of optimism in the air here, while there has been even a pullback. But I want to spend some time here not to talk about the pullback of the last few days, guys. As you all know here at this channel, we're not here to talk about short-term moves to the upside or short-term moves to the downside and to take sides in either direction. What we care about is the long-term trend direction. And I think when we're going into this conversation of 2024, we need to focus in here on what the long-term perspective should be, what we need to keep our eye on, and try to, kind of recognize the short-term emotions that can come in either direction from short-term moves, and how that can interfere with missing the big picture, right? So I want to go ahead and run through a couple of examples here. And I think right now, I feel, as I've been trading in markets for the last 12 years, while I don't always get every trade right, and I don't get every opportunity exactly right, and I'm not always right from a conceptual basis, it's important to understand that as you trade long enough, just like with any type of activity, you get certain habits or abilities that you just simply can't get when you trade for the first time. And the one thing I've built up over the last few years is an ability to sense that short-term emotion and to realize when it's getting towards extremes here and deviating from that long-term trend and trajectory that many people expect. And I want to go ahead and talk about one of those things here. There's been a lot of news over the past few weeks that essentially the Fed has done its job here. This is, I think, as we focus on the long-term perspective, the big thing we still need to be focused on in 2024. It is not out of the ballpark. It is the ultimate question we need to be focused on here. While it is boring sometimes, and it may seem dull and not so interesting, and it's not the latest, greatest altcoin or exciting investment opportunity, it is the topic of the Fed versus inflation. And if the Fed itself is not done its job of dealing with inflation, we have to pay attention, right? Now, there is some news pieces that have come out over the past few days, and from traders and investors who I highly admire to a large extent. People who have built up successful portfolios for themselves, like Stanley Druckenmiller, who's a legendary trader in financial markets, who came out recently stating he has a massive bullish bet on 2-year notes. This is the 2-year form of government debt in the United States. So again, betting essentially that bonds have bottomed and that the yields are not going to be heading up any higher from this point on, as we're likely anticipating a recession. So you have people, for example, like Stanley Druckenmiller, who's had more of a bearish or cautionary tone here, who believes that the recession is coming, and that essentially the Fed has done its tightening efforts. So it's essentially capped out here on the max rate. So you've got someone like Stanley Druckenmiller who's taking that more pessimistic view, who believes the Fed's done, recession's imminent, and therefore, essentially stimulatory efforts may be around the corner in the future. And then you also have people who are maybe more bullish or a little bit more on a different perspective, people like Bill Ackman, who have come out as well, and they closed their short position on TLT, which is the 20-year plus government treasury ETF. So you have all these comments coming out there saying like, whoa, these professional traders are all kind of coming out simultaneously and saying that the tightening efforts are done. And that means we got to expect the money printer, we got to expect lower interest rates, Bitcoin, financial assets as a whole must be ready to skyrocket. I must have missed the bottom, right? Anyone who's in the sidelines is feeling that itch of FOMO right now in the short term. And emotions ride high in the near term in both directions. When markets are moving down, bears are riding high and very confident, saying, I told you so, and yada, yada, yada. And vice versa. It happens on the bullish side as well. Well, I want to spend some time to talk about this here because, to be completely frank, I understand why Bill Ackman closed his shorts on TLT. I understand why Stanley Druckenmiller may feel the need to start building a pretty sizable bond bet in his portfolio. And the reason for this is because if we look at the long-term trajectory here, bonds have gone through an exacerbated sell-off to the downside. We've had an exacerbated rally here in March of 2020 during the bottom of the pandemic as people were rushing to safety in government bonds. And liquidity, of course, being printed at mass amounts, or the anticipation of that liquidity injection. A lot of people are expecting the Fed's almost kind of passive buying of bonds. So this just exacerbated it here from the 200-day. And after that, that was the absolute top. And bonds have ever since been correcting here in their underlying principal value on the financial markets. Cutting down in the case of the TLT ETF, which is one of the most popular ways that people will invest in bonds, essentially bringing it all the way down to its relative lows here back last month in October, down towards the same lows where it was back as far back as 2002. This means the bond market has wiped out over 21 plus years of returns. Just a matter of a little over 3 years, 3.5 years. Wow. Now, I understand some of you guys, I might be losing you here. You might be thinking, Nick, what does this have to do with Bitcoin? Why are we talking about bonds? It has everything to do with it, guys, because essentially what the bond market is doing, this is going to let us know where Fed monetary policy is really heading to a large extent. Right? So bonds here have been declining substantially because yields on those treasury notes, on those funds the government did, have been skyrocketing. It's not just the US, it's all across the board. So this is a global story here. Now, the big thing here, from a trader's perspective, I understand why someone might be buying the dip here on bonds after being sold off so dramatically and being so exacerbated away from the 200-day. And not to mention, testing that line of support that's been there for 21 plus years. I get where they are coming from as traders, but there are some important dynamics we need to understand here, guys. First off, just because Bill Ackman closes his shorts or Stanley Druckenmiller goes long here at this lows, it doesn't mean we need to go all in with what they did on a recent trade. And it's important to note that they're not doing all of this with all of their capital, right? They, as any kind of good money manager, are well diversified and hedged in either direction. And while this has definitely knocked down treasury yields over the past few days from the relative high at say 5% to 4.8%, it's important to understand that Stanley Druckenmiller and Bill Ackman and all these successful traders and investors, who I think are very respected in their own right, don't always get it right, and they also have plays in all different types of areas. They, for example, built positions back in May, relatively late into the trend of AI, going long on Google, or more specifically Alphabet and Microsoft, and a lot of these big companies within the overall AI space, as well as NVIDIA. So it's important to understand here that they have multiple bets placed in different directions. Their goals as traders or as money managers is not so much to pick one direction, put all your cards on the table and go long on it. No, that's not a smart way to do it. You can't afford to do that when you're managing other people's money, especially billions of dollars. There just isn't the liquidity to be able to make those trades so smoothly, by the way, as well. But the big thing you have to worry about is hedging yourselves, having bets in multiple directions, and essentially following one of Stanley Druckenmiller's biggest points, which is that your number one goal as a trader is to make sure that when you get it wrong, you lose less than the times when you get it right. Right? So you want to make more money getting it right versus when you get it wrong, right? Or essentially how much you lose when you get it wrong, right? I'm probably not doing it justice and explaining it, but you get my point here, generally speaking. You got to win more than you lose. It's okay to have failures here in the market. And that's a key point we've emphasized in this channel. It's not about catching every move, and it's not about always getting it right and taking on every opportunity. If you do that, you'll trip up, you'll lose money, you'll take too much risk at one point or another, you get out of your strategy, and you end up losing in the long term. We are not about that here on this channel. We're not about quick wins. We're about defending our principle and taking strategic moves where they matter. And my big point here I want to talk about is while there has been this little bounce up here in TLT that's got everyone riled up here, we had a similar bounce to this back in November and December of 2022 into January, when many people felt that peak rates were in and that the Fed was done in its tightening efforts. And as we can see here, that was not the case. And that was a pretty dramatic low that took us all the way back to where we were in 2011, cutting out more than a decade's worth of progress. But then again, we continued here downward here. We couldn't get past the 200-day. And my big point I want to talk about here is, as we're talking about the investment thesis for Bitcoin, the investment thesis for stocks, it comes back here to this fundamental question. Has the Fed done its job in dealing with inflation? Can we really return back to the era of easy money? And if the answer to this is no, then we do need to pay attention. All right, so let's go ahead and try to determine if it's a yes or no here. I understand it's subjective, people have different opinions, but I want to try to view this in a as non-biased view as possible, because we are still seeing here in indicators like the Dixie, the dollar index, that we're holding pretty strong here. The dollar's holding well against other currencies, and that doesn't really bode to me that the Fed has done its tightening efforts. But let's go ahead and think about this from a fundamental perspective, right? All right, we can see here from global liquidity, there's no serious trend change here, right? We've been, for the past month or so, past month of October, it was a relatively neutral month here. But generally speaking, we're still on a long-term downtrend here, well below the 200-week here for global liquidity. So no serious trend change here. The Fed has not stopped its balance sheet reduction, okay? Along with that as well, when we come here towards the fundamental element, right? And that is inflation in the economy, right? We know that the federal funds rate has not changed. They've decided to pause at this meeting. That was not a surprise. It's what most people expected. But the key thing here is whether or not the Fed has done its job in taking down inflation. Well, for the past few months, since back in June, here in July and August, and here in September, inflation has not only not gone down, it's broadly gone up. And it bounced at one of the most critical points we needed to break through, which is the 200-week moving average. Now, why is this significant? I'll take you back here to the 70s, during a period of time where, just like today, in many ways, shapes, and forms, it's not history directly repeating, but it certainly rhymes. We are having issues with the supply-demand imbalance for oil, right? We're having the same issues with the cost of living and inflation. And generally speaking, you can see back here how imperative breaking the 200-week would be in the fight against inflation, because each time the Fed unfortunately caved into market pressure and started to wait for the economic data, paused on its efforts, or started to actually cut back rates and re-stimulate markets, that's exactly what led inflation to come raging back here 2 extra times after the first initial wave to 6%. And each and every time, the 200-week was your guide here to let you know that inflation it has temporarily bottomed, but it's coming raging back. And that's not good for financial assets. It's what led the S&P 500, if we go way back throughout history, to have essentially a kind of lost decade here, a no trend scenario here into the 70s, only to be finally really broken here in the 80s when rates were finally brought up, inflation was cooled down, and from there on out, we entered into a multi-decade period of time into the 2020s where rates continuously went down across the board. So this is the key thing I want you guys to be aware of here, that we could be essentially in a lost decade here if the Fed does not do things right this time around. Now, I'm going to go ahead and let you guys know, in my opinion here, while the Fed, obviously I think, is being a bit silly by not raising rates here in the near term. I think they should just go ahead and get it done. I think the Fed is still on that camp of slowly but steadily doing things in a way where we're going to continue tightening. They're not going to enter back into the world of easy printing of money. They're not going to lower interest rates to 0%. There's practically nothing that is going to justify that, because inflation is the number one enemy. And while things may break in the economy, the Fed's message is tough luck. Right? There are going to be things that break. The Fed can't say it outright. They can't say that we're trying to cause a recession. It wouldn't be professional, and they just can't say that to save face. But that's the number one goal, because they need some things to bring the economy. They need that demand to go down here in the near term, and they need prices to correct so they can actually get back to the target rate of 2%. Right? We're still well elevated above that range. And as you can see, we came down here to pretty speedy direction here from June of 2022 to here in September, but it's going to take just as much effort here to get us down here, because this is a stubborn range of support here for inflation. Now, the big thing here I want to talk about is the scenario that I think some of you are probably hearing from other people. And again, it's this idea of a soft landing in the near term. Hey, the Fed's going to start to lower interest rates. The Fed may start to stop its balance sheet reduction. We're going to get back to maybe semi-good times or really good times as a whole. And that essentially is betting on the idea that the Fed is going to loosen monetary policy and stop its tightening efforts. If the Fed does this, guys, I'll be the first to say here in the near term, we'll be sitting in our cash position and probably miss out on a nice little bump up in stocks. And maybe we'll trade it, right? Maybe we'll ride the wave of that short-term optimism. But I gotta tell you guys, it's gonna be nothing but short-term. If the Fed does that, if they repeat the mistakes that they made over 50 years ago, which I don't think they're going to do, but if they do, we are in for a lot more pain in the long term. Because you're going to still essentially have stagflation in the economy. And more importantly, you're going to have a reacceleration, a much higher acceleration of inflation. You're not going to get any sustained economic growth. You're not going to get some huge bull market for the next 3 or 5 years that's easy to ride and invest in, where you can just go long on any stocks. You could get a monkey throwing darts who's going to perform just as good as any other hedge fund, right? It's easy to make money during those bull runs. The key point here is that we won't have the liquidity and the steam to actually make that happen. We won't have the narratives there because AI itself, one of the few remaining narratives, is fading under its own weight. It's not producing the kind of earnings or results that many people had expected. And because of that, this is going to lead us right back down to the same path we were heading before, except we're going to have a reacceleration of inflation over the next few months where the Fed is going to have to tighten more aggressively to try to knock it down. This is the key point here I want you guys to focus on here. Until inflation really gets below the 200 week, I'm not even interested in going long on equities and crypto here in the long term. Into 2024, I keep focused on that long-term perspective. I'm not worrying about, oh, what did Stanley Druckenmiller do here today? Or what did Bill Ackman do? Or what did this financial analyst on CNBC or Yahoo Finance or Bloomberg say? I appreciate all types of different opinions, and I listen to them. I'm not here to be a monolith of opinion, and I don't believe I've got everything right. But the key thing here that I know is fundamentally important is that the Fed cannot rapidly print money, nor can other global central banks. And it cannot lower interest rates for the federal funds rate and other central bank rates for the cost of capital if inflation is not below the range. Because if they do, it may provide some short-term relief, but then it's going to come back with a world more of pain. And I'm much more willing to sit by and wait for that buy the dip opportunity, or to wait for the Fed to do what's much more likely for them to do the right thing now, which is to tighten. Unfortunately, with each of these pauses, with each of these meetings where we wait for the economic data, the Fed is just walking on a tightrope. And it's avoiding the inevitable fate that eventually something is going to fall. Something's going to break. And I don't think that again, these comments here are really the things that are standing out to me. You know, Stanley Druckenmiller made a really, really good quote here. He did a big interview with CNBC recently, and he's kind of been doing the rounds with a couple different interviewers, and he brought up a really good point, which is that investing is going to be difficult for the next 10 years, guys. And this plays into my concept here of kind of the lost decade. Will there be opportunities? Will there be places to make money? Yes. Could it be Bitcoin and cryptocurrencies? Possibly. Could it be some entirely new stocks within the equity markets that right now are kind of mid caps that could become large caps and really become sizable companies or make 10, 20x multiples? Absolutely, there will be some plays there, and value will fall from other stocks. Even if the market is sideways, there will be those opportunities out there. But for those of you who are more kind of in the passive investing crowd, I'm just going to DCA in Bitcoin, kind of crowd, in one particular asset or one bet, or just buy the FANG stocks, I got news for you guys that may not continue to pay out for you like it has for the last decade. And I'm only saying that as a friend here. I'm not trying to threaten you or anything or say anything bad about your positions. I think those companies in many ways have built phenomenal technologies. I love Bitcoin and crypto from a fundamental perspective, especially the concept of having decentralized money that is fixed in its monetary supply. I think that should exist. It's a wonderful thing. I think there should be a Bitcoin ETF and all that. That all being realized, it doesn't mean that it's guaranteed to go up. And that's what we've been really trying to warn here for the past year. I know Bitcoin's had a great year in 2023. It's up versus down, but we need to be prepared and ask the question of what's going to happen in 2024 from here on out. Because if you're looking to deploy liquidity, if you are up on your money, or if you've held bags for a long period of time in crypto and now they're at a better position than where they were, you got to start asking those questions. And not get caught up in the short-term buzz of, oh my gosh, Bitcoin's at new relative highs for the year, and there's a Bitcoin ETF coming, and I have to FOMO in because it's just guaranteed. I gotta be honest with you guys here. There are a lot of fundamental questions to be asked. We mainly focused in on the topic of inflation today, but there's also the topic of a Bitcoin ETF. And to bring it back home to crypto here, we really gotta ask whether or not there are gonna be those inflows into the space. That's the biggest question you gotta ask with the Bitcoin ETF, because that's obviously going to be a positive event. Question is, have we already priced it in, so to speak? Right? And essentially, is there going to be the market order flow at this price point to continue outweighing the market sell side pressure, right? Is there going to be more inflows than outflows, or more essentially more buyers taking the best available price for Bitcoin due to a Bitcoin ETF versus sellers? And if that's not the case, if we're getting more sellers, that's going to drive down prices. I always, again, kind of bring it back here to what we've talked about with MicroStrategy. MicroStrategy has been a pseudo Bitcoin ETF for a long period of time. Yes, MicroStrategy is a traditional company, but at the end of the day, MicroStrategy has monetized all of its revenues. It has taken on as much debt as possible during a zero interest rate environment to go out and essentially buy Bitcoin. And their liquidation price is so low that it isn't even a threat for MicroStrategy at the end of the day. I'm, as someone who's bearish, I'm not here to say that MicroStrategy is going to get liquidated. My point here to say is that MicroStrategy is essentially a pseudo or de facto Bitcoin ETF at this point. And the question I have here is that if MicroStrategy, like it did back a few months ago, can find a private fund or anything and go out and mint new shares, essentially. Right? They did like a $750 million share agreement, issuance of new shares to go out and essentially dilute the share base, but then go buy more Bitcoin, which didn't really affect the holders of it, right? You still hold the proportionate amount you purchase as an investor. If MicroStrategy in the past year or so has really only had this one big purchase, where are the tens, if not hundreds of billions of inflows that are just waiting to get into this industry? And I've heard the common arguments of pension funds and all the types of different arguments, which, by the way, could easily go out and buy MicroStrategy today. MicroStrategy has the size, the ability for people to go build those positions now. And the question I want to ask is, what if those inflows have already come? What if they're already baked in? I have no doubt that there will be a few extra billions of dollars of inflows into, Bitcoin with an ETF. I understand the halving event is coming, and yeah, that will reduce Bitcoin's annual sell side pressure by a few $1 billion. The question is it enough to kick off a new bull market? And I have to be really honest with you guys here. I've covered the halving events for the past couple of years. I've also been a big advocate of a Bitcoin ETF, but I gotta tell you is I don't see it really being enough here. Bitcoin is at its current value a $675 billion asset. A couple $1 billion in benefits for supply reduction annually and new inflows is not enough to get me really juiced up about it. I need to know that there are going to be tens, if not hundreds of billions of dollars of new inflows into Bitcoin to really drive Bitcoin, not from its current value of $675 billion where it is now, but all the way up to trillions of dollars in market cap, which is where it needs to go in order to get back to 65K, to get on towards 100K, as so many people are betting on. And if we don't have those inflows, we got a serious problem. Now, if you guys want to see a bit of a more detailed approach and my kind of updated thoughts on Bitcoin, if this is something that's really on top of your mind at the moment, I cover some additional details within this month's edition of the Dash Report. This has been one of my favorite articles I've written in a while because I think it covers the important charts that you guys need to be watching, some of which we haven't covered here on the channel before, and I think are the ones that you really need to keep on your radar for whether or not Bitcoin really is in this new paradigm where it's entering into a new bull market, or if this has been the exacerbated blow off top of a relief rally. And we also cover some opportunities in equities, commodities, and Forex. We do a whole 20-page plus report for the Dash Report. We have our custom indicator that you guys get access to, the blue-red line for momentum indicator, our blue-red line momentum indicator. You also get access towards the trade alerts group, the discussion group. You join hundreds of other members out there. And above all, guys, it's a great way to support the channel where you guys can get up to 20% off each year. It's only $240 on an annualized basis or $25 a month. Again, less than a cup of coffee a day. It's a great way to support not only the free content we create here, but outside of that as well, to get some really great additional content to help you navigate this environment. I come back here to Stanley Druckenmiller's comment, which is that it is going to be incredibly difficult to trade over the next few years. I think that is one of the truest statements you could take away from this video, guys, going into 2024 and the rest of this decade. It is going to be a difficult period of time, and you're going to have to be outside the box. You got to be creative. You got to be looking elsewhere than just one particular asset or market like Bitcoin or crypto into it. I understand you may love one particular asset, but I can tell you guys that love can be really deceiving sometimes in financial markets. You can't fall in love with your investments. You got to be strategic with your capital. And here, that's my only goal here, is to make sure we preserve and protect your principal, guys, and we take well-coordinated moves so we can hopefully expand that principal with new returns. But anyways, I rambled on a good amount here, guys. If you enjoyed this video, consider dropping a like. If you want to check out the Dash report, I'll leave a link down below in the description where you can get 20% off on an annualized basis. But above all, I hope you guys have a fantastic weekend wherever you are. Take some time off away from the charts. Stay safe, trade smart, and I hope you guys have a wonderful rest of your week. And I'll see you guys on Monday at 6 a.m. Eastern Standard Time. Take care, everyone.